Coming up on market shares, the December Consumer Price Index was revised. See how much prices rose.
Plus, President Biden gave his State of the Union address on Tuesday. See what he said about fears and recession.
And the AI wars have begun. See what companies like Microsoft and Google are doing to compete with ChatGPT. Hold on to your wallets because market share starts right now.
Good morning and welcome into Market Shares. I'm Tegan Brown.
And I'm Bradley Hoppenstein. We're going to start things off today, per usual, with our market update. A bit of a rocky week for our major three indexes, mixed performance, and that really, again, as we've seen the past few weeks, lies on inflation and the Fed if they're going to continue raising rates. Let's take a look at the Dow. Pretty shaky week, ending at 33,869. Advanced about half a point on Friday, but down about 5 on the week. And again, we're really just waiting on the Fed announcement if they're going to continue raising rates. That'll help with the outlook on the rest of the year.
And coming up with the NASDAQ next. Now, for the last few weeks, we've been talking about how it's constantly been gaining. It had 5 weeks of gains before plummeting this week. This is the worst week since December, and it's mostly because of Lyft, Tesla, and Airbnb also plummeting.
Yeah, Tegan, actually the NASDAQ and S&P posting their worst week since December. S&P with a narrow gain on Friday, but again, it's worst week in nearly 2 months, and it really comes down to investors. Their attention's been divided between earnings reports, economic data, and predictions on what the Fed will do between inflation and rising rates. Movement in all three markets, though, as investors kind of changing their predictions on the Fed and the outlook on the rest of the year. Now let's get to our market movers. You're going to start things off with Moderna?
Yeah, so Moderna actually popping up this week, going down quite a lot, and it's mostly because that the COVID emergency is going to end on May 11th. So the stock kind of plummeting because people are going to have to buy these shots themselves. The government isn't going to buy them anymore. So a lot of really interesting factors going into Moderna, and it's likely that we're probably going to see it continue to go down in the next couple of weeks. And
if you take a look at Microsoft in the middle, we have a lot on the AI wars later in the show, but Microsoft announcing its new AI-infused Bing search engine so that you can see the stock spiking middle of the week. And that's combined with some layoffs from the company. Now, obviously, layoffs are not good, but it's a good economic outlook for the company. They're trying to save some cash. Stock spiking with the new AI.
And last up, we've got Airbnb. And if you were hoping we would talk about the Super Bowl today, we are, because the Super Bowl is impacting Airbnb. This really large amount of area in Arizona has kind of created a lot of competition, too much competition for Airbnb, which made the stock fall this week. And new data shows the Consumer Price Index increased 0.1% in December rather than decreased, as stated previously by the Labor Department. December wasn't the only month with revised numbers. November increased 0.2% rather than 0.1%. October was revised as well. These data changes are common and a routine annual procedure, while economists say we can't see any major implications when it comes to inflation changing with these numbers. They say that this is a positive sign that we could see those better numbers up ahead.
And as we mentioned earlier, Fed Reserve Chairman Powell, he's telling a cautionary tale. He says, yes, inflation's starting to ease, but it's going to be a long process. Interest rates could also continue to climb if the economy doesn't cooperate. Now, the markets, as we just saw, mixed on the week. They didn't love the news. But investors, they were initially predicting the Fed would stop raising rates. Now Powell is kind of changing Wall Street's outlook on the year. He says if inflation's running hotter than the Fed expects, that will mean more rate increases.
And weakening global demand, high inflation, and rising interest rates led the U.S. to its largest trade deficit on record last year. The Commerce Department says America had more imports than exports to the tune of almost $950 billion in 2022. Imports of goods and services fell the last 2 quarters of the year, while exports began to fall in the 4th quarter. The Commerce Department is blaming those drops on slowing consumer spending around the world. And 2023's numbers will depend on inflation and how much the Fed keeps pushing interest rates.
And now, turning politically, President Biden delivered his biggest speech of the year last week. Market Shares political analyst Luke Radel is here with his recap of Biden's State of the Union address. So, Luke, what is the State of our Union?
Brad, it's an open question, but according to the president, the state of our union is strong. His evidence to back that up, the jobs created on his watch.
2 years ago, the economy was reeling. I stand here tonight after we've created, with the help of many people in this room, 12 million new jobs. More jobs created in 2 years than any president's created in 4 years. The unemployment rate is at 3.4%, a 50-year low.
But those lines for Biden are a little bit misleading because he's comparing the incomplete jobs record from the first few years of his presidency to the full 4-year terms of his predecessors, which is actually something that former President Donald Trump also did during his 2020 State of the Union address.
Since my election, we have created 7 million new jobs, 5 million more than government experts projected during the previous administration. The unemployment rate is the lowest in over half a century.
So the script here seems pretty clear. If you're the president at the State of the Union, brag about X million jobs being created, and then tout the lowest unemployment rate in half a century before saying that you're the best president ever. But the lesson that Donald Trump quickly learned is that in the jobs market, you shouldn't count your chickens before they've hatched. Because 4 weeks later, the COVID pandemic hit. Unemployment skyrocketed and millions of Americans lost their jobs. The point? The number of jobs in the U.S. often rises and falls for reasons completely unrelated to presidential policy. In the context of Biden's job numbers, it's also important to note that these were jobs that had been created by people returning to the workforce post-COVID. Take a look at the jobs numbers from 2019 to present. In 2019, unemployment hovered around 3 or 4%, then spiked in the spring of 2020 for obvious reasons, and now we're seeing it fall and return to those pre-pandemic levels. So Tegan and Brad, it's unclear just how much of this is responsible for Biden administration policy, or if this is returning back to where we were before the COVID-19 emergency.
And Luke joining us at the desk now. So Biden blamed a lot of his problems on the previous administration, but he took credit for all of the good things happening right now. What evidence does he have to back that up, if any?
Yeah, well, the Biden administration's obviously worked very hard to reopen the economy and get people back to work, incentivize companies to hire back those jobs that were lost. We've seen a lot of stimulus money go to airline companies that were, hit pretty hard by the COVID pandemic, among others. We've seen big, returns in the workforce in healthcare and the service industry, but we've also seen a lot of tech layoffs. And so we've seen a similar tactic that we've seen from the president, as with other politicians, that when everything's going well, it's my fault. It's because of all the things I've been doing. But when things are going poorly, well, it wasn't me. It was responsible for somebody else.
Political analyst Luke Radel. Luke, thank you. Coming up after the break, a record number of Americans are withdrawing from their 401ks. See just how many when we come back.
Most party fouls are pretty dumb. But if you decide to drink and drive underage, you could lose your license and your freedom. Underage drinking and driving. The ultimate party foul.
Welcome back to Market Shares. Big week for the world's largest entertainment company, even if it looked like some of that magic was fading not too long ago. Disney reported earnings for the first time since CEO Bob Iger's return. His first quarter back, revenue up 8% from a year ago. Now, since his return, there's been some major shakeups at the company. He came back to a tall task, and as he said, it's time for a transformation. Disney cutting 7,000 jobs. That should save him about $5.5 billion. Now, Iger, in this return and on that earnings call, he mentioned this is all part of a massive shuffle and reorganizing at the entertainment giant. So let's break it all down. Iger's simplifying the corporate structure to 3 divisions: Disney Entertainment, so all the TV, movie, and streaming content; Parks and Experiences and Products, that one's pretty self-explanatory; and spinning off ESPN as its own division. The company was reportedly looking to sell ESPN and ABC last year, but never did. On ESPN, Iger says it's a differentiator for the company. Continues to create value for us. The brand is very healthy and the programming is very healthy. We just have to figure out how to monetize it in a disrupting world. Now, that's referring to dropping cable subscriptions and ESPN's push to move viewers towards ESPN+. So ESPN and ABC are safe, but there's a lot of pressure on Iger in one key area. That would be the media buzzword of the last year or so: streaming. He's been tasked with making Disney Plus profitable, but since it launched in 2019, it's lost the company nearly $10 billion. So last year, the company tried the tactic of just raising prices for Disney Plus, which actually resulted in a loss of subscribers. Now Iger says they're cutting back Disney Plus marketing, reviewing their subscription prices, and maybe even licensing more of Disney's content to other distributors. He says Disney Plus will reach profitability around 2024. Keep in mind the company also has a majority stake in Hulu, to which Iger says anything is on the table. But the biggest shock in that earnings report was Disney's Parks division, with revenue and profits spiking over 20% thanks to Iger lowering prices and the pandemic finally fading. That gave the stock a slight boost on Thursday while ending the week relatively flat. Now all we can do is wait, but all eyes will be on Iger's next quarter to see if earnings jump again. Tegan?
Bradley, thanks for that magical analysis. A record share of Americans sought hardship withdrawals in 2022 through their 401k plans. This comes as the U.S. continues to face a 40-year high inflation, among other economic severities. Here to join us to break down this trend is market shares analyst Dominic Chapone. Dominic, is inflation the only source behind Americans tapping into their 401k?
Thanks, Tegan. The simple answer is, as with anything regarding the economy, it's simply not that simple. Let's start off with some quick context here. According to financial services firm Fidelity, 1.9% of the 401k participants took hardship withdrawals in 2021. Last year, that number rose to 2.4%. Now, this all comes from a number of factors here. For starters, yes, Americans still are dealing with a 40-year high in inflation rate. That's led to a sharp increase in prices for food, gas, housing, and other needs. Speaking of prices, record costs for housing coupled with a stagnation of wage growth simply means the average American needs to tap into their 401k plan to pay for certain essential goods. Now, in simple terms, Americans can't afford to save money for retirement or life after work, and instead, those earnings go for emergencies like medical situations or filing for money to pay rent or keeping house payments on track. That's led to a new bill passed by Congress titled the Secure Act 2.0. The new law expands coverage for retirement plans and adds more regulations for employers to ensure they give money to their employees. This includes enrolling anyone starting a retirement plan after December 2025 and greater eligibility for part-time workers. Now, in the grand scheme of the future of the American economy, there are still obstacles preventing long-term positive growth. That hasn't deterred President Biden's vision for the economy moving forward. Take a listen.
The economy's growing at a solid clip. Folks, I hate to disappoint them, but the Biden economic plan is working. It's working.
And Dom now joining us at the desk. So Dom, a lot of economic obstacles this year. I mean, just talk about inflation alone, interest rates, mortgage rates, but is this 401k, do you think the American retirement plan can surpass all that? Do you think it can surpass these challenges?
The biggest challenge with the economy right now isn't the fact that people are tapping into their retirement plans. The problem is that they don't have enough money in the first place, and that is why they are tapping into those plans in the first place. When the IRS gives out a 401k hardship withdrawals, that's usually, again, for specific situations that involve, like, they need that money. Again, medical emergencies, things along those lines. What we're seeing now, though, is that Americans are doing this because they simply don't have the influx of cash to pay for goods like paying the rent. We've seen skyrocketing housing costs, skyrocketing rent costs, prices through the roof. So at the end of the day, the real challenge isn't that Americans need to take the money out of these accounts. This happens all the time. The challenge is that they are doing it at a record rate because of those economic factors.
And Dominic, I want to speak more about that new Secure Act 2.0 recently signed into law. You know, what are people looking at as of the pros and the cons of this new act?
Yeah, the simple answer is, like with anything with the economy, this thing has its half glass full, half glass empty take. The half glass full is that obviously expanding access for people to get access to retirement plans, especially through their 401k, is a huge bonus, especially with adding part-time workers to that, forcing employers to actually do that. But at the end of the day, that's just one problem in a series of complex issues with the economy. At the end of the day, when you've got profits increasing every year since 1970 and wages the same in 2023 as they were in 1973, at the end of the day, the American economy, and specifically working class and middle class Americans, can't afford to keep up with the evolution of prices and the evolution of this current economic stage.
Dom Chapone. Dom, thank you so much. Coming up after the break, January jobs report is surprising. Let's see why.
Dad, they took over my bedroom. Come on, come on. Okay, Dad. 1, 2, 3. Dad! You saved me. Dad?
Are you okay?
I'm fine, dear.
Your hero needs you now, and AARP is here to help. Find the care guides you need at aarp.org/caregiving.
Welcome back to Market Shares. The United States added over 500,000 jobs in the month of January in its job report. With the job market seemingly recovering from COVID-19 and recent economic hardship, Market Shares reporter Jacob Goldberg is in studio to break down the factors behind this gain. Jacob?
Well, that's right, Tegan. The jobs report certainly showing a lot of growth for the United States economy. That's some good news. 517,000 jobs were added in just the last month alone. The unemployment rate now sitting at 3.4%. All of this, of course, coming from the Department of Labor and the recent jobs report. So we look at unemployment by month. You know, is 3.4% actually good? Well, historically, yes, it's very good. You see the beginning of 2022, 3.8%. Now we've kind of gone all the way down. It dipped again, and now we're back down at 3.4%. But you might be thinking, well, 0.4%, that's not a lot. Well, you consider the fact that the United States has a population of roughly 350 million people. That's hundreds of thousands of jobs we're talking about that were added in our economy, 3.4% being very low historically for the United States. So now, going to the jobs added by each sector. Leisure and hospitality by far the most. That's going to happen with, COVID-19 factors. That was the biggest hit industry. Now we're seeing hospitality regain to begin 2023. Food services as well, another sector that was hit heavily in the beginning of 2020, 100,000 jobs added. Professional services, 82,000. Government jobs, 74,000. That was one of the biggest. Healthcare, 58. They're in a shortage right now, but still adding plenty of jobs. Retail, 30,000. Construction, 25,000. Transportation, 23,000. So even with sectors like technology losing plenty of jobs, we still see a very, very large growth in the overall jobs across the United States. Now, one area that was stressed heavily by this jobs report was unemployment by race. And you see some of the disparities between different races, Native Hawaiians, American Indians, almost at 6% unemployment versus whites, Asians, blacks, Hispanics, a little bit lower than that. And that's something that obviously needs to get better, but was stressed heavily in this year's jobs report.
Jacob, we've seen a lot of growth, a lot of bounce back with these jobs since the COVID pandemic. Has the job market fully recovered? Is that possible, or when is it going to happen?
Well, it's definitely, getting back there. The biggest is hospitality. Over 125,000 jobs were added in just January alone. It's still 3% lower than it was at this point in, March of 2020. So we're not fully back there yet, but still, over time it will maybe even get above pre-pandemic levels. And some sectors like tech, they did so well at the beginning of the pandemic, and now they're kind of coming back down to reality. So we're seeing a wide range of disparity, but overall good sign for the United States economy.
So Jake, a wide range of disparity, but how did the job market grow so quickly this quarter?
Well, it grew because of the Fed. We talked about Jerome Powell, before on market shares and how he's raising rates. This is gonna, help with, inflation. And when there's less inflation, things are cheaper. Companies are able to hire more employees. And we're actually seeing overall in the United States a lot of job security. With economists predicting a recession, you wouldn't think so, but overall, there's a lot of job security right now in the United States.
Yeah, we've been fearing that recession for a while, but haven't quite hit it yet. Now, turning to the tech sector, it feels like we've been seeing artificial intelligence in the news all year. And the tech industry is racing to capitalize on that recent excitement. So, with ChatGPT making headlines, tech giants are now advancing their search engines. They're adding AI into their software. Microsoft's new version of Bing is looking to threaten Google's dominant spot in the sector. Let's go to market shares analyst Gustavo Adolfo Madero. Gustavo, let's talk about Microsoft. Do you think this new version, this AI version of Bing, could give the company a head start in the AI space?
Thank you, Bradley. In the online war search for engine dominance, Microsoft has placed itself in front of the competition with over $10 billion invested in artificial intelligence. While it may seem that the whole world has jumped onto the artificial intelligence wave, it's important to note that Microsoft's partnership with OpenAI has been in development for over 4 years. Back in 2019, Microsoft invested $1 billion, which led to the creation of the supercomputer built into OpenAI models. After all these years of development, Microsoft announced on Tuesday the release of their new search engine called the new Bing. This new search engine will revolutionize the way we interact with the internet by providing a faster and seamless experience. New Bing will be able to provide services such as an itinerary for a new trip, calculating whether or not a purchase will be able to fit in your car by searching for the dimensions of both the item and the car, or even comparing one's company's financial statements to the financial performance of other companies. Yet, Microsoft continues to have ambitious goals as it continues to pour billions of dollars into OpenAI. They're looking to fuse the technology behind ChatGPT, image generator DALL-E, and other AI innovations into an array of Microsoft products tied to its cloud computing platform. With all these new and attractive features for its users, Microsoft's AI-driven strategy hopes to grab market share and transform an internet service that currently trails far behind Google. Yet Google seems to be playing catch-up. Google CEO Sundar Pichai announced a new conversational service named Bard that will be made available to a select few before being widely released later this year. Other companies such as Facebook parent Meta and Amazon are also working on similar technology, but after Microsoft's latest moves, they seem to be falling behind. We can expect this year to be filled with a lot of innovations and uncertainty as these tech giants fight to revolutionize the AI market. Who will come on top? Only time will tell. But for the moment, it is clear to see how Microsoft is currently leading the race. Back to the desk.
Gustavo, thank you so much. And coming up on Market Shares, our stock analyst Sean Dempsey is in studio to break down his top movers. Stay with us.
Fancy pants peanut butter? A big screen television? You haven't even bought a sofa yet. A motorcycle? When your father finds out, he's gonna flip his shoes with 2 buckles? What do you even need 2 buckles for? Mr. Big Shot, buying whiskey shots for everybody in the bar. From the looks of it, I'd say nobody even remembers. Feed the pig.
Here's to the straggly ones, the lopsided ones, the first ones, the I miss my beard ones. But hey, I look good with this ones. But no way he's grown that in a week ones. The black, brown, red, and gray ones. That one. The itchy ones. The never forgotten ones. The ones grown by Dad. The ones grown for Dad. The started late ones. The absolutely filthy ones. The drawn-on ones, the finger ones, the pin ones. The I nearly didn't do it this year ones. And the yeah, why not ones. They all raise awareness, raise funds, start conversations, and save lives. Because whatever you grow will save a bro. Learn more at Movember.com.
Welcome back. Now we welcome to the show our financial analyst, Sean Dempsey. Sean, what do you have for us?
Thanks, Bradley. A lot of stuff has been going on in the stock market this week. A lot of news has been brewing, I should say. And 3 stocks that I want to highlight are Disney, Google, and McDonald's. Let's start where the dreams come true, which is Disney. The company announced a plan to lay off 7,000 employees, restructure the company, and cut $5.5 billion in costs on Wednesday. This took place during its first quarter earnings call. CNBC market analyst Jim Cramer applauded Bob Iger for pushing to reinstate Disney's dividend by the end of 2023. He says it is a huge sign of confidence from management. The company suspended the dividend in early 2020 due to the COVID pandemic. The stock is now up about 27% year to date. And now, as you can see here on the stock chart of Disney for the past month, the stock has rallied 10% since January 19th. And this is mostly because of the overall market rallying and families traveling to Disneyland and Disney World over winter break. Now, another stock that has been in the news lately is tech giant Alphabet. The company lost $100 billion in market value on Wednesday after its new artificial intelligence technology produced a factual error in its first demo. Meanwhile, shares for Google's rival Microsoft rose by 3%. Microsoft announced this week that it would incorporate ChatGPT into products like its Bing search engine. It's going to take some time before investors know who's winning the AI game between Microsoft and Alphabet, but it's been clear over the past 2 days that Alphabet has a lot further to go to convince investors that it's on the right track. Now, as you can see here from Microsoft's stock chart, it's been doing well. It peaked at about $108 per share, but has since dropped 12% because of the news that was announced this past week related to AI growth in AI technology. And finally, we will wrap things up with everyone's favorite fast food chain, McDonald's. The Golden Arches are benefiting from inflation and rising food prices. Their competitors, Chipotle and other restaurants of that nature, are having a hard time attracting customers. However, McDonald's has now become the cheaper alternative option. The fast food giant said United States same-store sales climbed 10.3%, helped in part by low-income consumers returning more frequently. Executives also credited the success of its adult Happy Meal promotion and the annual return of the McRib for its strong sales growth. Now, for McDonald's stock chart, it has been doing very good as of late. No strong positive or negative move, but that's because the stock jumped 21% in October. And like I said before, this is because of consumer sales and people choosing to eat a lot cheaper than going out and being expensive and going to different restaurants. Now, in October, it was seen that the stock had a big jump, but because of the rise in inflation, people started to eat cheaper. Bradley, Tegan.
Yeah, so I mean, talking about these, people wanting to eat cheaper, we've seen in other times of economic down times and hard times that people turn to fast food over these more so fast casual food places that we also see in the market.
Right. I mean, we could see that this week with McDonald's and Chipotle actually announcing their earnings. They took a dip, so that really shows you where people are going.
Yeah, I mean, Chipotle raised their food prices and people saw that in their wallets, but with McDonald's it seems that because it's fast food, people are just more willing to go grab food and leave, while Chipotle, you have to walk in the store and it's this sort of experience.
Right, well, I just mentioned a second ago this difference between fast food and this casual fast food. So fast food, McDonald's, Burger King, Chick-fil-A, all those types of places, whereas these fast casual places are, Chili's, Red Lobster, all of these. And actually, Chili's traffic fell 7.6% this quarter because of these fast food chains, taking in the customers.
Right, they're taking some of that market share.
They are taking some of that market share. You're right, Bradley. And I think that really shows with consumers not choosing to go out to some of these high-end restaurants, and not even high-end restaurants, just restaurants in general, opting more to go to Burger King and McDonald's and not spend as much money because they're thinking with their wallet.
Yeah, and I mean, you look at the consumer price index. I mean, prices are still up. Consumers are still spending less. Inflation's still up. Wages aren't keeping up with inflation. So people looking for a cheap meal, McDonald's up 10%. I mean, that makes a lot of sense.
Yeah, I mean, we had Luke talk earlier and Jacob as well talk about basically the jobs, these lower job rates, but we still have, people struggling, inflation, all of these different aspects. I mean, Sean, do you think that we're going to kind of continue to see these fast food places stocks continue to rise, or do you think it's going to change anytime soon with these, differing inflation numbers?
That's a great question. I would say over probably the next 3 to 4 months, you'll see those stocks continue to go up, but as inflation trends downward, you're going to see those stocks start to fall and people start to go to high-end restaurants once again.
Sean Dempsey, Sean, thank you. One more question, Eagles or Chiefs tonight?
I'm taking the Eagles, Bradley. I don't know about
you. That's a good choice.
I'm going Kansas City. I'm going Kansas City. That's all the time we have for you this morning on Market Shares.
Be sure to follow us on Twitter and Instagram at CitrusTV News and like us on Facebook. I'm Tegan Brown.
And I'm Bradley Hoppenstein. Have a great Sunday, Syracuse.
Enjoy the Super Bowl.